silver has fallen by 10% in a matter of hours, a move that has dominated financial headlines and market commentary, often framed as a sudden loss of confidence in a single commodity or a technical breakdown in a volatile market. Prices collapsed with unusual speed, liquidity thinned visibly, and traders watched screens update faster than explanations could form. Yet the narrow framing now circulating misses the central issue entirely, because this move was not driven by a reassessment of silver's long-term value, industrial demand, or supply conditions. What unfolded was a systemic event, one rooted in the mechanics of liquidity, leverage, and forced behavior inside modern financial markets. By the end of this analysis, it will be clear that silver's decline is not the story, but rather the signal, and that the real forces at work extend far beyond the metals market itself. This is an environment where understanding structure matters more than reacting to headlines, and remaining through the full analysis will provide that structural clarity. The critical question is not why silver fell so quickly, but what the speed and character of that fall reveal about stress elsewhere in the system. Under normal conditions, silver is treated as a hybrid asset, part industrial input and part monetary metal, with price movements typically reflecting shifts in manufacturing demand, currency expectations, or broader inflation trends. The market is considered deep, liquid, and resilient, capable of absorbing large trades without violent dislocations, precisely because silver futures, ETFs, and physical markets operate across multiple venues with constant participation. This assumption of resilience underpins not only speculative trading, but also hedging strategies used by manufacturers, miners, and institutional investors. The belief has been that even during periods of volatility, price discovery remains orderly, anchored by fundamentals, and buffered by liquidity providers willing to step in when dislocations appear. However, this belief rests on a critical condition that often goes unspoken, namely that participants are acting voluntarily rather than under compulsion. In the present environment, that assumption is increasingly fragile. Financial markets today are deeply interconnected through leverage, collateral chains, and risk models that treat liquidity as a given rather than a variable. Institutions operate on the premise that liquid assets will remain liquid even during stress, that bids will exist at some price, and that temporary volatility can be managed through margin adjustments and risk offsets. What the recent silver move suggests is that these assumptions are already being tested. When an asset known for depth and constant participation experiences a double-digit decline within a single session, accompanied by elevated volume and widening spreads, it indicates not a recalibration of value, but a breakdown in the normal functioning of liquidity itself. Stress does not announce itself loudly at first. It appears as anomalies that are easy to dismiss until they are no longer isolated. To understand why this matters, it is necessary to revisit earlier moments when similar assumptions failed under pressure. History offers several examples where markets believed to be stable and self-correcting revealed hidden fragilities once leverage and confidence intersected under adverse conditions. One of the clearest modern parallels occurred during the global financial crisis, when assets traditionally viewed as safe or uncorrelated suddenly moved together in ways that contradicted prevailing models. In the years leading up to that period, financial institutions operated within a framework that assumed continuous liquidity, manageable counterparty risk, and the ability of central banks to intervene decisively if stress emerged. These assumptions fostered aggressive balance sheet expansion, widespread leverage, and a reliance on short-term funding that functioned smoothly until it did not. As confidence eroded during that earlier crisis, the first signs were not dramatic collapses, but subtle distortions in funding markets and asset behavior that seemed inconsistent with fundamentals. Liquidity began to retreat not because assets lost intrinsic value, but because participants needed cash immediately to satisfy obligations elsewhere. Assets that could be sold were sold, regardless of their quality or long-term outlook, while assets that could not be sold simply froze in place. This distinction between desirable assets and sellable assets became decisive, and markets that were assumed to be shock absorbers instead became transmission channels for stress. The relevance of that episode today lies not in surface similarities, but in the underlying mechanism, where forced actions override rational pricing and reveal where pressure is truly building. At this stage, the comparison remains incomplete, but the early signals are difficult to ignore. The speed of the silver decline, the absence of a fundamental catalyst, and the concurrent strain visible across related markets suggest that the system is once again operating closer to its constraints than commonly acknowledged. Liquidity, often treated as abundant and automatic, appears increasingly conditional, dependent on confidence that may already be eroding beneath the surface. Whether this episode remains contained or develops into something broader will depend on forces that extend well beyond any single asset, raising questions that cannot be answered by price charts alone. The earlier crisis demonstrated with clarity that liquidity is not a permanent feature of markets, but a conditional one, present only as long as confidence in counterparties and funding structures remains intact. During that period, gold and silver experienced sharp, counterintuitive declines at moments when systemic risk was rising most visibly, confusing observers who expected safe havens to appreciate under stress. The explanation was not psychological, but mechanical. Highly leveraged institutions facing margin calls needed immediate cash, not overvalued assets or theoretical hedges. They sold what could be sold quickly, regardless of long-term conviction, because survival depended on meeting short-term obligations. Once liquidity returned through extraordinary central bank intervention, those same assets recovered and eventually exceeded prior highs, but only after the forced liquidation phase had fully played out. What is critical in revisiting that episode is understanding the sequence rather than the outcome. The liquidation of precious metals did not mark the end of the crisis, but its early acceleration phase, a moment when pressure became visible in the most liquid corners of the system before spreading elsewhere. The same pattern repeated during the market shock of early 2020, when a global health emergency triggered a sudden scramble for cash. In that instance, treasury markets themselves briefly malfunctioned, and gold declined sharply alongside equities as funds, corporations, and institutions sought dollars at any cost. Again, intervention restored order, but only after volatility had exposed the system's dependence on continuous liquidity provision. These episodes are relevant now because they reveal how stress propagates through modern markets, beginning not with defaults, but with liquidity withdrawal. The current silver decline fits this historical pattern with unsettling precision. There has been no comparable deterioration in supply dynamics, no abrupt collapse in industrial usage, and no policy announcement that would rationally justify such a rapid repricing. Instead, the characteristics of the move suggest urgency, scale, and non-discretionary selling, hallmarks of forced behavior rather than strategic repositioning. When similar signals appeared in the past, they were often dismissed initially as technical anomalies or isolated events, only to be recognized later as early warnings of broader instability. The lesson is not that history repeats exactly, but that systems built on leverage and confidence tend to fail in familiar ways when pressure exceeds tolerance. The recurring pattern is straightforward, yet frequently misunderstood. Periods of apparent stability encourage increasing leverage, tighter margins of safety, and greater reliance on models that assume normal distributions of risk. Liquidity is treated as an input rather than an outcome, something that exists by default rather than something that must be earned continuously through trust and balance sheet capacity. When conditions shift, whether due to policy changes, geopolitical shocks, or financial imbalances, that assumed liquidity retreats, exposing the underlying fragility. Assets that were once diversifiers begin moving together, correlations converge, and volatility accelerates. Early signs often appear in markets that are deepest and most actively traded, because those markets become the first source of cash when stress emerges. This is where the present moment demands particular attention. The signals are emerging in assets that should, under conventional assumptions, provide stability rather than volatility. The fact that they are not doing so suggests that the system is responding to constraints rather than preferences, to obligations rather than analysis. Observers who focus exclusively on narratives about individual markets risk missing the broader implication, which is that liquidity itself is becoming selective. The question, then, is not whether this pattern is recognizable, but whether the conditions surrounding it allow for the same resolution as before. This time, critical differences constrain the available responses. In previous crises, authorities entered with relatively clean balance sheets, low inflation, and considerable policy flexibility. Interest rates could be cut aggressively, asset purchases expanded without immediate political resistance, and fiscal support deployed at scale. Today, those options exist in theory, but are far more limited in practice. Inflation remains elevated across major economies, constraining monetary easing. Public debt levels are significantly higher, narrowing fiscal room. Central bank balance sheets are already expanded, reducing the marginal effectiveness of further intervention. These constraints do not eliminate the possibility of response, but they raise the cost and complexity of action. At the same time, the structure of the global economy has evolved in ways that amplify vulnerability. Supply chains are more fragmented, geopolitical tensions more pronounced, and industrial systems more dependent on critical inputs that cannot be easily substituted. Silver, in this context, is not merely a financial asset, but a component embedded in energy transition technologies, electronics, and defense systems. A disruption in its market behavior therefore carries implications beyond investment portfolios, touching on production planning and strategic resource considerations. When liquidity stress intersects with physical dependence, the consequences extend beyond prices into real economic activity. These structural constraints mean that any response to emerging stress will likely be reactive rather than preemptive, shaped by immediate pressures rather than strategic design. Markets may test the boundaries of tolerance before authorities intervene, increasing volatility and uncertainty along the way. The near-term window in which these pressures converge is narrowing. As funding conditions tighten, risk premiums adjust, and participants reassess exposure. The resolution, whatever form it takes, will be driven less by intent than by necessity, less by optimal policy design than by the limits imposed by existing conditions. Whether stability can be restored without exacerbating other imbalances remains an open question, one that will define the trajectory ahead. The near-term pressure window now forming is defined not by a single date or event, but by a convergence of constraints that are already narrowing the range of outcomes. Funding markets are becoming more sensitive to volatility, collateral requirements are adjusting upward, and institutions that rely on leverage are increasingly exposed to even modest adverse moves. As liquidity thins, market reactions become faster and less forgiving, leaving little room for gradual adjustment. In such conditions, relatively small catalysts can produce outsized effects, whether through unexpected policy language, currency instability, or a sudden repricing of risk in credit markets. The participants involved are not only investors and traders, but also regulators, central banks, industrial consumers, and governments, each operating under different incentives and limitations. The tension arises because these actors are responding to the same stress from opposing directions, some seeking to preserve capital and others attempting to maintain confidence, all while the system's capacity to absorb shocks is diminishing. What makes this period particularly sensitive is that decisions are increasingly constrained by timing rather than preference. Institutions facing margin pressure cannot wait for clarity. They must act immediately to preserve solvency. Policymakers confronting market stress cannot easily signal patience without risking further instability, yet decisive intervention carries inflationary and political costs that are no longer abstract. This creates a reflexive environment in which market behavior influences policy expectations, and policy expectations in turn influence market behavior, compressing reaction times and amplifying volatility. If additional liquidation occurs, it will not be because participants have suddenly reassessed long-term value, but because structural pressures have reached a point where action becomes unavoidable. The strongest unresolved tension is whether the system can absorb this adjustment gradually or whether it will be forced into a more abrupt realignment. Amid this backdrop, it is important to address the narratives currently circulating that seek to reassure or simplify the situation. Some commentary frames the silver decline as a technical correction following an extended rally, emphasizing chart patterns or positioning data while ignoring the broader context of simultaneous stress across asset classes. Others suggest that strong economic data or resilient consumer spending negate the possibility of systemic risk, conflating short-term indicators with structural stability. These interpretations focus on surface-level signals while overlooking the mechanics of liquidity and leverage that operate beneath them. Stability in narrative does not equate to resilience in structure, and confidence expressed publicly does not eliminate constraints faced privately by institutions managing risk in real time. Another common argument is that markets have become more robust since previous crises due to improved regulation and transparency. While certain safeguards have been strengthened, the complexity and scale of the system have also increased, creating new channels through which stress can propagate. Leverage has not disappeared, it has migrated. Liquidity has not become infinite, it has become more conditional. Risk has not been eliminated. It has been redistributed across instruments and jurisdictions that are harder to monitor and coordinate. These realities mean that while the system may appear more orderly on the surface, it can still respond abruptly when confidence erodes, particularly when multiple pressures converge simultaneously. The silver decline, viewed through this lens, is not an isolated anomaly, but a manifestation of deeper dynamics at work. It reveals how quickly markets can transition from orderly to stressed when liquidity becomes scarce, and how assets traditionally viewed as stabilizers can become sources of volatility under compulsion. This is not a single event to be explained and forgotten, but part of an ongoing process that will continue to evolve as conditions change. The core issue exposed is not the valuation of silver itself, but the fragility of a system that depends on continuous liquidity in an environment where that liquidity is increasingly constrained. As developments continue to unfold, two questions deserve sustained attention. First, will authorities prioritize short-term stability even if it exacerbates longer-term imbalances, or will they tolerate deeper market adjustment in an effort to restore discipline at the cost of immediate pain? Second, how will institutions and individuals adapt to a landscape where assumptions about diversification, liquidity, and policy support can no longer be taken for granted? These questions do not have immediate answers, but they will shape decisions and outcomes in the months ahead. This situation remains dynamic, and its significance lies not in the magnitude of a single price move, but in what that move reveals about the underlying system. Understanding these structural forces is essential for navigating what comes next, particularly as pressures build before they become widely recognized as crises. For continued analysis of developments as they emerge, rather than after they are fully visible in headlines, viewers are encouraged to subscribe and remain engaged as this story continues to evolve. An additional constraint that distinguishes the current environment from previous episodes is the altered composition of market participants themselves. Over the past decade, a growing share of liquidity provision has shifted away from traditional dealers toward non-bank entities, algorithmic strategies, and passive vehicles whose behavior under stress differs materially from that of regulated intermediaries. Market-making capacity, once supported by bank balance sheets willing to absorb temporary imbalances, is now thinner and more conditional, constrained by capital rules and internal risk limits. When volatility rises sharply, these participants tend to withdraw simultaneously, not out of panic, but because their models are designed to reduce exposure precisely when uncertainty increases. This structural retreat of liquidity providers exacerbates price moves and accelerates dislocations, particularly in markets that rely on continuous turnover to function smoothly. Compounding this issue is the growing dependence on collateral valuation across the financial system. Modern finance is not merely leveraged. It is collateralized in layers, with the same assets often pledged multiple times across different transactions. When prices of liquid assets, such as silver, gold, or government bonds, decline abruptly, the impact is not confined to mark-to-market losses. Collateral values fall, haircuts increase, and borrowing capacity contracts, forcing institutions to post additional assets or unwind positions. This process tightens financial conditions mechanically, independent of central bank policy intent, and can propagate stress rapidly across institutions that appear unrelated on the surface. The decline in silver, therefore, should be viewed not only as a price movement, but as a potential trigger affecting collateral chains that extend far beyond commodity markets. Another factor intensifying current pressures is the global nature of funding mismatches. Dollar liquidity remains central to the functioning of international finance, yet access to dollars outside the United States has become more sensitive to risk sentiment and policy expectations. When stress emerges, global demand for dollar funding rises sharply, strengthening the currency and increasing the burden on borrowers with dollar-denominated liabilities. This dynamic places additional strain on emerging markets, multinational corporations, and international financial institutions, which may respond by liquidating dollar liquid assets to meet obligations. In this context, declines in precious metals can coincide with dollar strength, not because metals have lost relevance, but because they serve as one of the few globally accepted sources of immediate liquidity. These dynamics suggest that the system is now operating with less tolerance for error than in previous cycles. Small shocks can have disproportionate effects because buffers are thinner, reactions are faster, and confidence is more fragile. Markets that once absorbed stress gradually now tend to reprice abruptly, reflecting a shift from discretionary judgment to rule-based responses. This environment favors speed over reflection and amplifies the consequences of forced actions, increasing the likelihood that stress will surface first in liquid markets before becoming visible elsewhere. For observers attempting to assess what comes next, attention should focus not on daily price fluctuations, but on the behavior of liquidity itself. Signs such as persistent widening of bid-ask spreads, rising funding costs, and increasing correlation across traditionally distinct asset classes provide more insight than isolated headlines. These indicators reveal whether the system is stabilizing through voluntary risk-taking or deteriorating through involuntary adjustment. The distinction matters because recovery driven by confidence differs fundamentally from stabilization imposed by intervention, and the latter often carries longer-term consequences that extend well beyond the immediate crisis. In this sense, the silver decline serves as a diagnostic event rather than a conclusion. It exposes the sensitivity of the system to liquidity shocks and highlights the limits of narratives that rely on surface-level explanations. Whether this episode remains a contained warning or evolves into a broader adjustment will depend on how these underlying pressures resolve, and on whether confidence can be restored without exhausting the remaining tools available to policymakers and institutions alike.